Hey everyone, welcome back to Corporate Decoder, the place where we decode the hidden stories within company filings. And this week we're diving into Equus Total Return Incorporated's latest quarterly report. And let me tell you, it is a real mixed bag of oil gas and a bit of a strategic pivot. Let's just say they are really hoping to transform this company. So this filing is actually an amendment to a previous report. This is amendment number 1 on a Form 10Q. And the big reason for this amendment is to properly tag everything with something called inline XBRL. That is basically a way to make financial data more machine readable. So a lot of the core information is the same as the original report, but they're just making it digitally friendlier. Equus Total Return Incorporated is a Delaware corporation and its shares trade on the New York Stock Exchange under the ticker EQS. Now their stated goal is to maximize total return for stockholders. This means both income from investments and capital appreciation, or growth in value. They typically invest in companies with a total enterprise value between $5 million and $75 million, focusing on growth through acquisitions, leveraged buyouts, and special situations. Looking at the balance sheet for the 30th of June 2025, we see total assets of about $37 million and total liabilities. Around $3 million, this leaves them with net assets of over $34 million, compared to about $29.5 million at the end of the previous year, so their net asset value has grown. Their capital in excess of par value shows a slight increase from about $74.8 million to $75.5 million, an indication of new capital coming into the company. However, their accumulated deficit, which represents past losses, is a bit of a concern. It stands at over $41 million as of June 2025. That is a pretty significant number, which tells us the company has a history of not being consistently profitable from a net income perspective. The net asset value per S-Hare has increased from $2.17 in December 2024 to $2.51 in June 2025. This is a positive sign showing growth in the value of their underlying investments. Now let's dig into the statement of operations for the 3 months ended the 30th of June 2025 and compare it to the same period last year. Overall, they are reporting a net decrease in net assets resulting from operations of about $86,000 for the first quarter of 2025 compared to a nice increase of $3.9 million in the same period of 24. That is a pretty stark difference. Looking at the 6-month period ended the 30th of June 2025, the net increase in net assets from operations is around $3.8 million. This is up from about $1.5 million in the first half of 2024. So the first half of 2025 appears much stronger overall. Compensation expense is notable at $1 million for the first 6 months of 2025 compared to $905,000. In the prior year, this increase is attributed to officer bonuses related to certain company dispositions, which is understandable as they are managing assets. A significant item here is the net realized loss of over $4.1 million related to control investments, which is a big change from zero in the prior year. This indicates they've likely sold off some significant holdings and took a loss on those sales. The unrealized appreciation of portfolio securities is quite strong for the first 6 months of 2025 at over $9.8 million. This is a huge jump from $3.4 million in the same period of 2024. This suggests their remaining investments are doing quite well. Now let's look at the cash flows for the 6 months ended the 30th of June 2025. They used about $2.2 million in operating activities. This is a much better position than the prior year when they used over $13.5 million in operating activities. That improvement is largely due to the adjustments made to reconcile net loss to cash from operations. Financing activities show about $2 million in borrowings under a margin account, and zero in repayments for the first half of 2025 compared to significant activity in the prior year where they borrowed nearly $107 million and repaid over $97 million. This suggests they are not relying on short-term margin financing as heavily as they did last year. The number of shares outstanding remained constant at 13.586 million shares. The schedule of investments is where things get really interesting. Especially for the 30th of June 2025, total investments are valued at over $33 million, with a cost of about $14.7 million. This highlights the appreciation in their portfolio control investments are valued at $22.8 million, making up about 68% of their total investments. Notably, their control investments have a cost of $10.5 million. This means they've seen a substantial unrealized gain on these holdings. Non-affiliate investments are valued at over $10.6 million, and here the cost is $4.25 million, showing good gains here too. The fair value as a percentage of net assets for their limited liability company investments is 36.2%, and secured and subordinated debt is 52.2%. Combined, these make up over 88% of their net assets. By industry, energy remains their dominant focus at 67% of their portfolio. This energy concentration is significant, showing 67% of their net assets are tied to this sector. Now, looking at the schedule of investments for the 31st of December 2024, their total investments were valued at $27.5 million, all of which were control investments. This shows a significant shift towards non-affiliate investments in the first half of 2025. Their control investments were valued at $27.5 million in December 2024, compared to $22.8 million in June 2025, while their non-affiliate investments grew from nothing to over $10 million in the same period. The valuation of investments, especially for level 3 assets, those with unobservable inputs, is crucial for Equus as a business development company, or BDC. They have a detailed process involving their board audit committee, and often independent valuation firms. This is essential because they often hold investments for which there are no readily available market prices. For their level 3 investments as of the 30th of June 2025, the fair value is over $26 million, a good portion of their total investment portfolio. The key unobservable inputs here include things like proved reserve multiples, daily production multiples, and discount rates. For their energy holdings, this means the valuation is heavily dependent on their estimates of future performance and market conditions in the energy sector. For their control investments in limited liability companies, the weighted average proved reserve multiple is around 6.4 thousand, and the daily production multiple is around 26.7 thousand. These numbers are pretty technical, but they essentially are metrics used to value oil and gas assets based on how much oil and gas they can produce and what that is worth. The discount rate for some of their energy investments is around 11.25%. This is the rate they use to calculate the present value of future earnings. If that rate is higher, the present value of those future earnings goes down, and vice versa. Their senior debt in Morgan E and PLLC shows a company-specific yield between 10.82% and 12%, which is pretty standard for this type of debt. For their warrant valuations, they are looking at expected volatility in the market between 107 to 110%. This high volatility suggests a lot of uncertainty around the stock price of the underlying company. Under their description of business and basis of presentation, we see they elected to be treated as a BDC, that is a business development company, but they previously qualified as a regulated investment company, or RIC, which offered tax advantages. Now in the fourth quarter of 2024, they elected to not qualify as a RIC, which means they will be subject to normal corporate income taxes. This is a pretty big shift. The report also touches on the impact of economic and geopolitical events on the oil and gas sector. With oil prices stabilizing and natural gas prices fluctuating, they see consolidation activity in regions where their portfolio companies operate. Now, this is a really important part under liquidity and financing arrangements. They explicitly state that substantial doubt exists about their ability to continue as a going concern. Why? Well, their cash and cash equivalents were only about $70,000 at the end of June 2025, and they do not have enough cash on hand or projected future cash flows to fund their operating activities. They might need loans or capital investments, or have to sell off some investments, and they don't have any guarantees of securing that financing. This is a serious red flag. On the 7th of February 2025, they issued a 1-year senior convertible promissory note for $2 million interest at 10% per annum, and this note is convertible into shares of common stock at a conversion price of $1.50. Per S-Hair, they also issued warrants for almost 2 million shares at the same exercise price. These warrants are accounted for as equity and were valued using a Black-Scholes option pricing model. The assumptions here suggest a stock price of $1.24 with an exercise price of $1.50. So the option is slightly out of the money currently. In terms of new investments, in the first 6 months of 2025, they purchased a 1-year senior convertible note from General Enterprise Ventures Incorporated, or GV, for $1.5 million with a 10% interest rate, and also received warrants for over 1.8 million shares of GV common stock. The GV stock is publicly traded and increased in value from $1.20 to $1.95 in the second quarter, which is a good sign for this part of their investment. They also sold Equus Energy to North American Energy Opportunities Incorporated, or NIOC, for $1.25 million in cash, and preferred stock. This sale represents a significant divestment. A major strategic theme is their plan to convert Equus from its current status into an operating company. They have authorization to withdraw their BDC election, but need further shareholder approval and a definitive agreement to actually make the transformation. This entire effort is geared towards a transformative transaction, likely a merger or acquisition, where Equus would become part of a different operating business. They have a 2016 equity incentive plan which allows them to grant restricted stock and options to employees, directors, and officers. The maximum number of shares subject to awards is over 2.4 million shares. And as of June 2020, all those awards were fully vested, but they did approve the issuance of additional restricted shares on the 1st of July 2025. The company's main operating entity seems to be Morgan E and P LLC, a wholly owned subsidiary focused on oil and gas properties in the Williston Basin, North Dakota. This entity is also facing going concern issues with very little cash and the need for external financing to continue operations. The management discussion section reiterates many points, including the ongoing efforts to transform Equus into an operating company. They acknowledge the current market conditions, particularly in the oil and gas sector, and the impact on their portfolio companies. The report details the ups and downs of oil and gas prices throughout 2022 to 2025, noting the stabilization of oil prices and the volatility in natural gas prices. The US economy is showing mixed signals with decent GDP growth, but slowing job creation and persistently high mortgage rates inflation is also a concern, with potential upward pressure due to new tariffs. Merger and acquisition activity remained strong in the first quarter of 2025, even with trade policy uncertainties. Private equity activity, however, has softened with reduced deal volumes and fundraising. Compensation expense at $433,000 for the 3 months ended the 30th of June 2025 was higher than the prior year's $477,000, and for the 6 months it was $1 million versus $905,000 in the prior year. These increases are notably linked to officer bonuses tied to portfolio dispositions. The net investment loss was $610,000 for the 3 months ended the 30th of June 2025, a slight improvement from $880,000 in the same period of 2024, and for the 6 months it was $1.7 million in 2025 versus $2.0 million in 2024. This shows some positive expense management. Now let's touch on controls and procedures. There is a material weakness identified in their internal controls over financial reporting, specifically related to the valuation of portfolio investments. This means there is a not insignificant chance that a material mistake in their financial statements could go unnoticed. They are working on improving these controls, but it is an ongoing process. The risk factors section highlights the significant risks associated with their plan to transform Equus into an operating company. This involves uncertainties related to potential mergers, acquisitions, and the specific businesses they might combine with. They also point to ongoing market volatility and the general risks described in their annual report. Finally, looking at the exhibit section, we see references to their articles of incorporation bylaws, safekeeping agreements, and their 2016 equity incentive plan. These are mostly standard corporate filings, so that is a lot of information about Equus Total Return Incorporated. Their financial health shows some promise with growth in net asset value and positive performance in some investments, especially the newer ones like in general Enterprise Ventures Inc., but there are some serious headwinds: the substantial accumulated deficit, the going concern warning, and the material weakness in financial controls. Paint a picture of a company in transition, and frankly facing some significant challenges. Their strategy to become an operating company is a bold move, but no doubt a risky one. The success of this depends heavily on their ability to secure financing and find a suitable operating business to merge with the reliance on energy, and the valuation of those assets also adds a layer of industry-specific risk. What is my take? Well, the increase in net asset value. Per share is encouraging, and the improved operational cash flow is a positive step. However, the going concern warning cannot be ignored. It signals a very real possibility that they might struggle to meet their short-term obligations without significant external funding. The transformation into an operating company is their lifeline, but it is a high stakes gamble. The market clearly sees some risk with a significant discount on their stock price compared to net asset value. This is a company that is definitely one to watch very closely, because the coming months will be absolutely critical for its survival and future. Alright, that is our breakdown of Equus Total Return Inc.'s latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. This analysis was valuable. Hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.